The story begins with a ledger that no one intends to close. In Washington, the books never truly balance. They breathe, they molt, they whisper. Every dawn, the US. Treasury walks into its auction room like a priest into a cathedral, lighting candles before a congregation of dealers from JPMorgan, Goldman Sachs, and Citigroup, of sovereign wealth funds from Abu Dhabi and Oslo, of money market funds managed by BlackRock and Vanguard, and of one old billionaire in Omaha who prefers short-dated promises he can fold in his pocket. The ritual is simple. Offer paper, receive cash. Roll the past into the future. Count the interest like rosary beads and begin again tomorrow. By early September of 2025, the total federal debt sat around $37.5 trillion, a stack of obligations that could circle the earth in paper chains. Roughly 30 trillion was owed to investors in the markets, and a little more than 7 trillion was the government owing itself through trust funds like Social Security and Medicare. That is not fiction. It is recorded each evening in the Treasury's own Debt to the Penny report, a grim little truth that updates with the persistence of a metronome. Officials will tell you, with the patience of actuaries, that this is manageable because the dollar still rules the world's vaults. Central banks from Ottawa to Kuala Lumpur hold their rainy day savings mainly in greenbacks. The Federal Reserve's researchers say about 58% of disclosed global reserves sat in dollars as recently as last year, far above the euro, the yen, the pound and the Chinese renminbi. That privilege is not a crown, it is a magnet. It pulls savings into treasury auctions and keeps the machinery humming, yet magnets weaken if you heat them too long. Look more closely at the debt's anatomy and you find a heart that beats faster each year. Net interest, the price of yesterday's decisions, has become one of the largest bills in the federal budget. Non-partisan scorekeepers at the Congressional Budget Office project, that interest will approach $1 trillion this fiscal year and is on track to keep setting records as a share of the economy in the years to come. In quiet language that would make any stoic sweat, they add that by the mid-2030s, interest alone will consume a frightening share of tax revenues. The Committee for a Responsible Federal Budget sharpened that point, noting that interest costs are already crowding out other priorities. The number does not blink, the number eats. The great secret, of course, is that the United States does not plan to repay the national debt in the way a household retires a mortgage. It plans to refinance forever. The elegant term is rollover. Bonds mature and are replaced by new bonds. Bills come due and are paid by issuing more bills. It is a conveyor belt that carries obligations forward while the economy grows around them, the way a river widens as it moves from mountain to plain. In a nation with its own currency and a central bank, this is less scandal than design. The scandal begins when growth falters, when politics freezes, or when the interest due climbs faster than the tax receipts can follow. To understand why just paying it down is a ghost story we tell ourselves, consider the scale and the tempo. As of the summer of 2025, Treasury officials expected to borrow more than $1 trillion in net new marketable debt in a single quarter to keep the cash drawer at a safe level. Meanwhile, about 1/3 of publicly held marketable debt was scheduled to mature within the next 12 months, an immense wall that must be rolled at the going rate. The nation's credit card does not need you to pay it off. It needs you to make the next minimum payment forever, and it needs the rate to stay gentle. But the rate is not always gentle. Fitch stripped the federal government of its last perfect grade from that firm in August of 2023, citing an erosion in governance and a rising debt burden. More recently, Moody's joined the chorus, removing its top rating in May of 2025. Standard & Poor's had fired the first shot back in the summer of 2011. The bond market shrugged in the short run, as it often does when the house that issues the world's reserve currency receives a scolding. The underlying message, however, is not ambiguous. It says the margin for error is narrowing. There is also the matter of who actually holds those promises. Japan has stood as the largest foreign creditor, with a sum measured comfortably above $1 trillion in recent months. China, the geopolitical foil in so many headlines, still holds several hundred billion. London's role as a financial hub puts the United Kingdom near the top of the table as well. Foreigners, however, are only part of the picture. US banks, pension funds, insurers, households, the Federal Reserve, and money market funds hold the lion's share. Warren Buffett's Berkshire Hathaway, awash in cash and wary of overpriced targets, has turned into a colossus of treasury bills. The global hunger for safe, liquid assets is the quiet ally that makes the conveyor belt possible. History insists on a darker footnote. Countries do repay big wartime debts, but not the way a diligent borrower repays a bank. After the Second World War, the United States watched its debt burden, measured against the size of the economy, collapsed from a mountain to a hill over 3 decades. It was not magic. Scholars Carmen Reinhardt and M. Balins-Brancia explained that the trick was a cocktail of moderate inflation, capped interest rates, capital controls, and captive savings. They call it financial repression, the subtle taxation of bondholders through negative real returns. Growth helped, but policy did the heaviest lifting. This is how a sovereign lightens the ship without tossing any cargo overboard. You could say, then, that the United States literally cannot repay its national debt for the same reason a river cannot return to its source. The modern treasury market is not a loan, it is an ecosystem. It feeds money market funds with bill supply, it anchors bank collateral, it undergirds the dollar's role in trade and reserves. To repay, in the ordinary sense, would be to drain the marsh where commerce nests. The more realistic question is whether the river floods its banks. Flood is when interest eats the budget. Flood is when auctions struggle. Flood is when the magnet that is the dollar begins to tremble. The psychology that helps produce these floods is older than the bond market. Daniel Kahneman and Amos Tversky wrote about how humans dislike losses far more than they value equivalent gains. Prospect theory shows that when governments face the pain of cuts today versus the abstract loss of a larger bill tomorrow, they choose tomorrow nearly every time. On our better days, we call this prudence. On our honest days, we call it fear. Layer on David Leibson's insight about hyperbolic discounting and you see the real ghost in the chamber. We are wired to prefer the immediate relief of borrowing to the long, slow grind of reform. Democracies are not built for self-denial, they are built for the next election. The consequences unfold, with small, relentless steps. The Congressional Budget Office's long-term outlook now shows debt held by the public rising over the next decade and beyond, with interest costs projected to reach levels that once would have been dismissed as fantasy. Their technicians also warn that eventually the average interest rate on the debt will exceed the economy's growth rate, which is an economist's way of saying the hill gets steeper as you climb it. In that world, stabilization requires primary surpluses that our politics has not delivered for a very long time. The math is insensitive to speeches. Here's the tension. The Treasury can always print the dollars to pay the bills, but it cannot print trust. If investors begin to fear persistent inflation, they demand compensation. If they believe Congress will flirt with the debt limit as a bargaining chip, they widen the term premium, the extra yield for lending long. If they worry that entitlements will expand forever without the revenue to match, they glance nervously at the exit doors. These concerns are not constant. They crest and fade, like the unseen tide under a boat. But they never disappear, and every rating downgrade or bruising standoff leaves a ring on the hull. So what does cannot repay mean in practice? It means there is no politically plausible path to run sustained primary surpluses large enough for long enough to retire the principal. Paying off the tab would require, for years on end, a mix of higher taxes, lower spending, rapid growth, and a kind of national stoicism rare outside of war. Instead, the United States will do what powerful debtor nations have always done. It will refinance, it will lengthen or shorten the maturity profile as markets allow, it will count on the dollar's gravity. It will occasionally welcome inflation when the alternative is pain, then swear it did no such thing. It will nudge banks and funds to hold more treasuries, call it prudential regulation, and sleep soundly. Behind the scenes, the mechanics matter. Much of the debt matures quickly, so small changes in rates ripple through the interest bill with eerie speed. That is why one quarter's borrowing needs can exceed $1 trillion, and why auctions for 4, 8, and 13-week bills sometimes set records. The face in the glass is not Uncle Sam waving a payoff check. It is a borrower in excellent standing who has made the market itself dependent on his continued presence. Supply is not a glitch, it is nutrition. Foreign creditors will be part of this ritual as long as the United States remains the safest ugly balance sheet in a world full of lovable risks. Japan will keep buying because its institutions need liquid stores for a nation of savers. China will keep a hand in because it prefers exchange rate stability to geopolitical theater, even while trimming exposure at the margins. London will keep clearing the trades because the city knows how to turn liquidity into rent. Meanwhile, at home, Buffett's bills will quietly mature and be rolled again, a private echo of the public habit. This is not a moral tale. It is plumbing. There are only 5 real levers in the end. Go faster than the interest rate. Run primary surpluses for years. Inflate away a slice of the real burden. Engineer a form of financial repression that keeps borrowing costs below inflation. Or default. History shows that responsible nations choose a blend of the first 4 and keep the 5th in a locked drawer with a cracked glass that no one wants to tap. After the last World War, the United States shrank its debt ratio using precisely that blend and scholars have spent a decade reminding us that growth alone did not do the job. The cost was paid silently by savers, retirees, and anyone holding safe assets that earned less than rising prices. The technique works. It also leaves a taste of copper in the mouth. Investors who understand this do not panic. They study maturities the way sailors study clouds. They ask whether the average time to the next rate reset is lengthening or shortening. They listen carefully when the Treasury Borrowing Advisory Committee meets and when the department signals a swing toward more bills or more longer-dated notes. They read the monthly Treasury statement the way detectives read bank records. They know that the danger is not a single missed payment. The danger is a slow grind where taxes buy less policy because an ever larger share is claimed by interest. In behavioral finance, there is a parable about the ostrich effect, our habit of burying our heads in the sand when the news turns sour. Prospect theory gives that parable teeth. We choose to risk larger future losses to avoid smaller present pains. Hyperbolic discounting explains the sequel, in which we promise austerity tomorrow after one more round of borrowing tonight. Nations are made of people, balance sheets are written in our own hand. The story of the American debt is the story of human time preference with flags attached. The end of the tale is not a crash in which the United States cannot pay as a bankrupt cannot pay. The end of the tale is a revelation that repayment was never the point. The point was continuity. The point was a market whose very health requires a deep ocean of safe assets. If the ocean rises too fast, it erodes the shore. If the ocean recedes too far, ships run aground. The work of policy is the work of tides. For the long-term investor, the lesson is cold and useful. Watch the ratio of interest costs to revenue. Watch the share of bills in issuance and the pace of rollovers. Watch the real yield on 10-year notes, because that is where repression hides in plain sight. Diversify beyond home assets, but do not bet against the dollars plumbing lightly. Cathedrals endure because congregations need somewhere to kneel. The Treasury's cathedral will be open again tomorrow at 10 in the morning. The candles will be lit. The congregation will file in. The prayers will be whispered. The ledger will breathe. And the debt will be rolled, not repaid.